This presentation is going to introduce the mental accounting bias. So what is mental accounting? Mental accounting is the tendency of investors to separate different amounts or different types of investment into different accounts and ignore the possible interactions, which is why it's so hard to tell people to hold the market portfolio, right? Why it's so hard to explain the overall benefit of diversification for your portfolio. So the idea behind it is that not all dollars are created equal, except they really are, which is kind of the problem. So imagine that you just bought a ticket to a Broadway show. At the theater, you realize that you lost a ticket which cost $100, but you have the money in your wallet to replace it. Do you spend another $100 to see the performance, yes or no? A lot of people would argue, well, I'm already there and I have the money, so maybe. But now imagine the same scenario, except you're planning to buy the ticket when you arrive. At the box office, you realize you lost a $100 bill out of your wallet. You still have enough money to buy the ticket, meaning you had like $200 in your wallet. Now you only have $100 in your wallet. Do you buy it, yes or no? And in reality, these are both asking about spending $200 for a $100 ticket. Yet what happens is that many people will answer no in the first case and yes in the second case, even though, bottom line, they're the same, right? It's the same as you paying $200 for the ticket no matter what. So you might argue, well, yeah, we've already talked about this kind of idea. This is an idea of, this is an example of a violation of expected utility. And it's true, it is. But now we're talking about an explanation for that violation. What causes us to see these two situations as different and to change our opinion in each case? And the idea is mental accounting. So why? Insights into how mental accounting works. People who say no in the first instance reason that spending that what amounts to $200 for a play is just too extravagant. I mean, it's not like Hamilton here. We're talking just, normal average play. Not as bad as Cats, not as good as Hamilton, somewhere in the middle. Okay, if you said yes in the second example, then your argument would be, well, I guess that first $100 is just bad luck, and the second $100 is what I'm going to pay to see the movie. So you're actually putting it in a separate quote unquote mental account. Oh, it sucks that I lost that, but I still have the money. In either case, you're out $200 at the end of the day. And so it really doesn't matter whether you could afford $200 to see the play, whether you thought, $200 was worth it to see the play. What we're seeing here is the mental accounting system. And we see a significant difference between the two cases based on the mental accounts in which we put those $100 each respectively. Another example, should you use your savings account to pay off your credit card? Assume that you have a savings account that's paying 8% in interest at most. So this is like, several year old example. No savings accounts are paying you 8% unless this savings account is invested in the market, but not the market right now. I looked at my 401k. Don't do that. It's very scary. Okay. But your credit card is costing you 16% at least. So the rational answer is yes, you should take any of the money that you have in your savings account. It's earning you half of what your balance on your credit card is costing you. So yeah, you should definitely go and pay off your credit card with as much as you have. But from a budgeting point of view, this can be disastrous. And then, especially if you're going to run up your credit card again, mental accounting can help us budget when it gets, but when it gets too tied strongly to past circumstances, it leads to irrationalities. So if this was a one-time thing, this one-time credit card balance, and you will still have enough in your savings account to be able to cover an emergency and covering your living expenses for the next month, then definitely pay off your credit card. You want to carry as small of a balance as possible. But this idea of separate mental accounts is one of the ways that allows us to continually make the mistake of, oh, I'm just putting it on the credit card. It's just a small balance. It's just this. It's just that. And seeing it separate from the holistic decision of this is what my income is, this is what my spending should rationally be. Another example, what do you do with your tax refunds? How do you feel about the tax refund? Is it kind of the same way as lottery winnings? Or do you think about it as, hey, I've been giving the government a free loan for the past 12 months. So rationally, should you try to maximize your tax refunds? The answer is no. Many people treat a tax refund as an unexpected bonus or mad money and spend it in ways that they wouldn't spend their savings. But in reality, your tax refund just means that you did not take all of your tax deductions throughout the year, right? So you gave the government a free loan. I'm sorry, but the government does not need a free loan from you, right? So now assume you minimized your tax refunds, i.e. you didn't give a free loan to the government. Now what ends up happening is that you take additional funds each month and put that money into your savings account instead. You would undoubtedly spend the same amount of money in quite different ways. So if you claimed everything that you should in order to minimize your refund, then you got that, you realized what that amount of money is that was coming in each month and that differential, and you decided to invest that or spend it, your spending decisions would be different. And I think you can see that rationally. You might argue that it's only because each month it would be like $5-10, max $100 when you get a real-time job, real full-time job, but versus a tax refund, that's a couple thousand, there I could really buy something. But there, when it's that larger amount, is where the impact of the mental accounting really hits you and where you really could make the worst possible mistake as a result of it. So you need to be aware of it to prevent problems with this bias. The final example I'm going to give you is imagine your grandma just died. Sorry for your loss. BDE, Baruch Dynamis is something that Jews say to each other, so I'm sorry. Your hypothetical grandma just died. But she left you a small inheritance. And also, you liked her, but you didn't like her so much, so, you're okay with this. All right. Now, how do you feel about this money? Does it feel different from found money or the proceeds of gambling or the proceeds of a tax refund? Well, most of us love our grandma, right? So are you going to go and spend that on, are you going to gamble that money away? Are you going to go and spend it on expensive luxuries? Or are you going to be more conservative about it? If grandma leaves us the money unexpectedly, we may decide we should be very careful with a windfall and keep it in savings instead of investing it, because we're saying, oh, well, it's from grandma. So the question really becomes, is it still grandma's money? No, it's your money, and it's found money. It's money you were not expecting. So how should you feel about the money? Rationally, you should feel the same as proceeds from gambling or a tax refund. First, you add the inheritance to your overall financial picture, but now forget about the history of the money. It doesn't matter where the money came from. The money is now part of your money. So given your new overall financial situation, how do we what's our best way to invest that? Does it go directly into my portfolio? Or do I separate it out? In reality, money is fungible, meaning funds are completely interchangeable. I shouldn't be segmenting, this is my savings for vacation, this is my savings for retirement, this is my savings for my child's college education. Rationally, what I should do is, in order to maximize the impact of compound interest, right, is put it all into one account, stick it in with the interest rate, the highest risk that I can bear in order to get that highest rate of return and maximize that. But what we see is that people are just not comfortable with that concept. We feel the need to segregate our money into separate accounts.